It's the end of election week, Friday. The official vote was taken on Tuesday. We still don't know who the president is. But more importantly, financial markets are getting back in stride. So again, looking at the dashboard, I'm looking at the dollar, the 10-year, gold, S&P, and crude oil futures. Now, what I noticed Wednesday into Thursday was that the inverse correlation... Actually, let me rephrase that. The safe haven correlation between the dollar and the 10-year had completely broken, and the 10-year started trading like a risk asset, meaning that it ran inverse to the dollar instead of with the dollar. Also, with the uncertainty in the market, I was having a hard time understanding why gold was... Well, I understand why gold's up because the dollar's down, but why stock's up and why oil prices were up as well. Well, wrapping up the week, things seem to be getting back into line. The stock market rally seems to be faltering out, which, again, the fundamentals are not there. COVID's getting worse. Why should stock prices be going up right now? Nothing's changed from a monetary standpoint. So again, why should risk assets be increasing? Oil prices in line with other commodities, because even as of today, the dollar is still technically falling. It looks like it's putting in a floor, but it looked like it put in a floor for the past couple of days, and then every morning you wake up, it's a little bit lower. But looking at the commodity complex, energy commodities and soft commodities, agricultural commodities, they're all starting to lose momentum. So I'm looking at crude oil, I'm looking at corn, and I'm looking at wheat, and they all seem to be pointing towards lower prices, which lines up with the fundamentals of the macroeconomy, with Europe in the position that it is in due to COVID. And once the United States sobers up from election euphoria, we have to get back to dealing with an accelerating COVID numbers in the United States as well. And added to that, a reduced chance of a large fiscal stimulus, because there is a divided government. Okay. So I guess as of today, the correlation between the dollar and the 10-year went positive again. Yesterday it was a strong negative. Today I was looking at it, it was positive, but it was weak positive. So my assumption is, over the next few days, or as the election results are announced, the normal relationship between the dollar and the 10-year realign. They both start moving in tandem as safe haven assets. Investors revert back to a need for liquidity, which supports the dollar, and the need for safe haven or safety, which supports prices on the 10-year treasury. And to fund, they will sell stocks, so that's the S&P. They will short economic activity through commodity prices. It's crude oil for energy, less energy consumption, especially through Europe and the northern hemisphere. Soft commodities, corn, wheat, less demand, for food supply, less demand going into agricultural feed, less demand overall for soft commodities, so lower prices. And of course, the uncertainty that's created, the economic uncertainty that's created from still COVID, will drive investors to seek out safe havens, which would benefit the dollar, the Japanese yen, and the Swiss franc. Looking at Japan is having a better time dealing with COVID, but their economic growth numbers are not reflecting that. Switzerland is having issues with deflationary pressures, which in the long term could be beneficial for their currency, as it does benefit the Japanese yen. But from a liquidity standpoint, I think the safe haven that garners the most interest would still be the US dollar. And increasing prices on the US dollar would, by the function of the markets, push down the price on gold. Which lines up with the idea that global developed economies are in a deflationary or at best a disinflationary cycle, which means that there is no inflation hedging based demand for gold to support the price, only industrial demand. And because of the COVID and shutdowns, there should be reduced industrial demand for gold as well. So, two things working against gold right now: gold prices and the dollar eventually correct, and the correlation between the 10-year and the dollar also realigns. If the dollar goes higher, the 10-year travels higher with it, higher prices, lower interest rates, which is what the Fed is trying to accomplish with its monetary policy, quantitative easing. It benefits the federal government because the interest on the debt is low. It benefits borrowers, long-term borrowers in the United States. Mortgage rates remain low. So the 10-year Treasury price traveling higher with the dollar as a safe haven is actually a benefit to the U.S. economy overall. And also provides an opportunity for the Federal Reserve to monetize some debt and repay the interest paid on that debt back to the Treasury to support fiscal stimulus without the fear of runaway inflation. All right, well, that's today.